Welcome back to BitcoinDorks. Today, we're delving into an exciting topic that's been buzzing in the crypto space: Bitcoin Exchange Traded Fund, ETF, issuers locking up significant portions of Bitcoin supply. It's a development that's caught the attention of many, so let's dive in and explore what this means for the crypto market. First off, let's clarify what a Bitcoin ETF is and why it matters. A Bitcoin ETF is a financial product that tracks the price of Bitcoin and allows investors to gain exposure to the cryptocurrency without actually owning it. It operates similarly to traditional exchange-traded funds, offering investors a convenient and regulated way to invest in Bitcoin through their brokerage accounts. The introduction of a Bitcoin ETF has long been anticipated in the crypto community, as it could potentially open the doors for institutional and retail investors to enter the market on a larger scale. Now, onto the recent news. Several Bitcoin ETF issuers have been aggressively acquiring Bitcoin and locking up sizable portions of the cryptocurrency's total supply. This development has sparked speculation and debate about the potential impact on the market, particularly in terms of supply dynamics and price appreciation. So, why are these ETF issuers stockpiling Bitcoin, and what does it mean for the broader crypto ecosystem? One of the primary reasons behind the accumulation of Bitcoin by ETF issuers is the anticipation of regulatory approval for a Bitcoin ETF. Over the years, numerous proposals for a Bitcoin ETF have been submitted to regulatory authorities such as the U.S. Securities and Exchange Commission, SEC, but so far, none have been approved. However, there's growing optimism that regulatory sentiment towards Bitcoin ETFs is becoming more favorable, especially with the increasing institutional interest and adoption of cryptocurrencies. By stockpiling Bitcoin ahead of a potential ETF approval, issuers aim to ensure that they have an adequate supply of the cryptocurrency to meet investor demand once the ETF is launched. This preemptive accumulation of Bitcoin helps to mitigate the risk of supply shortages and price volatility, ensuring a smoother and more stable market transition when the ETF goes live. Additionally, holding a significant portion of Bitcoin supply could give ETF issuers greater influence and bargaining power in the market, allowing them to negotiate favorable terms with liquidity providers and custodians. The accumulation of Bitcoin by ETF issuers could have far-reaching implications for the cryptocurrency market, extending beyond the immediate impact on supply dynamics. As more Bitcoin is taken off exchanges and held in ETFs, the available supply for trading on the open market decreases, potentially leading to supply shortages and upward pressure on prices. This reduction in circulating supply could create a scarcity effect, driving up demand and fueling Bitcoin's ongoing bull run. With fewer Bitcoin available for purchase on exchanges, investors may be more inclined to hold onto their existing holdings, expecting prices to continue rising. This could create a self-reinforcing cycle of price appreciation, attracting even more investors and institutions to the market in search of profit opportunities. The prospect of a sustained bull market could further solidify Bitcoin's status as a store of value and a hedge against inflation, bolstering its appeal among mainstream investors and institutions. As more investors allocate capital to Bitcoin and other cryptocurrencies, they contribute to the growing adoption and mainstream acceptance of digital assets as legitimate investment vehicles. This increased institutional participation not only provides liquidity and stability to the market but also helps to legitimize and validate the long-term viability of cryptocurrencies as an asset class. The accumulation of Bitcoin by ETF issuers could lead to greater market efficiency and price discovery. By removing Bitcoin from exchanges and holding it in ETFs, issuers effectively remove a portion of the circulating supply from the open market, reducing the potential for short-term price manipulation and volatility. This could lead to more stable and orderly price movements, allowing investors to make more informed decisions and reducing the risk of sudden price crashes or flash crashes. Additionally, the presence of Bitcoin ETFs could attract a more diverse range of investors, including institutional investors, pension funds, and retirement accounts, further diversifying the investor base and contributing to market resilience. However, it's important to consider the potential downsides and risks associated with the accumulation of Bitcoin by ETF issuers. While a sustained bull market may seem like a positive development for investors, it also carries the risk of excessive speculation and irrational exuberance. As prices continue to rise, investors may become overconfident and complacent, leading to inflated valuations and unsustainable price levels. This could create a bubble-like scenario, where prices detach from underlying fundamentals and eventually collapse, resulting in significant losses for investors. Moreover, the concentration of Bitcoin holdings in the hands of ETF issuers raises concerns about centralization and control within the market. If a small number of issuers hold a significant portion of Bitcoin supply, they could potentially wield disproportionate influence over the market, dictating price movements and market sentiment. This concentration of power could undermine the decentralized nature of cryptocurrencies and lead to increased regulatory scrutiny and intervention. In conclusion, the accumulation of Bitcoin by ETF issuers represents a significant development that could have profound implications for the cryptocurrency market. While it may lead to increased institutional adoption and mainstream acceptance of cryptocurrencies, it also raises concerns about market manipulation, centralization, and excessive speculation. As the market continues to evolve, it's essential for investors to remain vigilant and informed, carefully evaluating the risks and opportunities associated with investing in Bitcoin and other digital assets. That wraps up today, and we'll see you in the next video.